Hello, everyone. Allow me to introduce our TACC602 group. My name is Yin Zhang, and I'm joined by Chang Liu, Junping Niu, and Zheng Yuchen. We are engaging presentation for our group assignment. As a group, we have worked on our assignment. Today, we are sharing our findings and insights with all of you. Our presentation will shed light on the subject matter, providing a deep understanding and addressing key aspects related to the assignment. We're excited to showcase our effect and present our ideas in a clear and manner. Now, in the first part of our presentation, I will be addressing the vertical analysis of the income statements for Tiger Company and Loin Company. Based on the vertical analysis, the following conclusion can be drawn. From income statement analysis for Tiger Company, the cost of goods sold accounts for 63.82% of sales, indicating a relatively high proportion and suggesting a need for focus on cost management efficiency. Loin Company has a low cost of goods sold, representing 71.93% of sales, indicating better cost control compared to Tiger Company. Both companies have relatively low operating expense, accounting for 14.61% and 15.15% of sales respectively, indicating efficient operational control. The interest expense for Tiger Company is 1.50% of sales, while for Loin Company, it is 1.84%. This suggests that Tiger Company has more efficient financial management compared to Loin Company. Loin Company has a higher net profit before tax, representing 11.09% of sales, compared to Tiger Company is 10.04%. This indicates that Loin Company achieves a higher profitability relative to sales. Loin Company also has a higher net profit after tax, representing 9.25% of sales, compared to Tiger Company's is 8.59%. This suggests that Loin Company maintains a higher level of profitability after accounting for tax. From balance sheet analysis, cash represents 5.23% of Tiger Company's total assets, while for Loin Company, it represents 7.93%. Loin Company maintains a relatively higher cash reserve, indicating better liquidity. Accounts receivable accounts for 20.18% of Tiger Company's total assets, while for Loin Company, it respects 15.33%. This suggests that Tiger Company has a relatively higher proportion of accounts receivable, requiring attention to risk management and cash collection compatibility. Both companies has a significant proportion of inventory, representing 22.71 and 70.82% of total assets. This may indicate a higher capital investment in inventory management. Tiger Company's property, plants, and equipment represent 46.30% of its total assets, while for Loan Company, it accounts for 54.76%. This suggests that Loan Company relies more on fixed assets, requiring additional capital investment and asset maintenance. In conclusion, the vertical analysis provides insights into the differences between Tiger Company and Loan Company in terms of sales cost, profitability, cash management, and asset allocation. These conclusions offer valuable to assess the financial position and operational efficiency of the companies, serving as reference points for decision making by investors and stakeholders.
I'm Jin Chen. Based on the ratio analysis of the two companies, let's measure the financial health in terms of liquidity, solvency, efficiency, profitability, and market perspective. In liquidity, both Tiger Company and the Loan Company have a correct ratio of 1. Indicating that the correct issues are issued to cover the issued liabilities, which may suggest a limited ability to meet short-term obligations. In terms of the quick and asset test ratio, Tiger Company has a lower ratio of 0.04 compared to Loan Company's ratio of 0.50. Impacting that Tiger Company has a lower ability to cover its short-term abilities using its most liquid issues. In CFC, both companies have relatively low debit ratios, with Tiger Company at 0.22 and Loan Company at 0.21. It suggests that they have a comparative level of debit relative to the total issues. The debit to equity issues for both companies are also relatively low, likely that they have a reasonable balance between debit and equity financing. In terms of times interest earned, both companies have a similar ability to cover their increased expenses within efficiently. Loan Company outperforms Tiger Company in terms of asset and notes receivable turnover. This sales in the receivable efficiently turnover and they sales in inventory is indicates that Loan Company is more efficient in managing its reliability and efficiently. Additionally, Loan Company has a higher total issues turnover, meaning that it generates more sales per amount of issues. In profitability, both companies have provided gross profit margins, net profit margins, and returns on total issues and required. However, Lion company generally outperforms tiger company in use profitability measures. Lion company has higher gross profit margin, net performance margin, and issues, suggesting better profitability and efficiently in generating profit from sales and issues. In market perspective, Tiger company has a higher ratio of 90.69 compared to Lion company's ratio of 60.70. It entails that insurers are willing to pay a higher price for Tiger company's shares ratio to these earnings. A lower PE ratio usually means that the stock is undervalued, which wider PE ratio means that that a stock is overvalued. Lion's PE ratio of 13.9 is lower than Tiger's 90.69, meaning that Lion stock may be undervalued and that investors may be more likely to expect future increase in Lion stock price relative to Tigers. Both companies have the same limited weight of 6%, suggesting a similar return on limited through derivatives. Overall, while both companies show positive indicators of financial health, Lion's company generally perform better in terms of the profitability and efficiency. The Lion company has a higher profitability, better efficiency in managing accounts, receivable and efficiently, and the higher total assets turnover ratio.
The financial ratios present a clear comparison of Tiger and Lion companies. In liquidity, both companies have a characterization of one, but Lion has a higher quick ratio. In solvency, the debt ratios and debt to equity ratios are closely matched, with similar times interest earned. References ratios show the line with higher receivables and inventory turnover, leading to fewer day sales inventory. In profitability, Line has higher gross profit margin, net profit margin, and ROA, while Tiger excel in ROE. In market perspective, Line boasts a lower PE ratio, but also has a 6% dividend yield.
Hello everyone. Good evening. I'm Junping Niu, a member of the TACC602 group. Now I'm going to give you the first part of the presentation about what is the better investment choice. Take all Lion stocks. Our group has conducted a vertical analysis and financial ratio analysis. In the vertical analysis, Lion had higher gross margin, better EBIT, higher cash reserves, no account receivable. Overall, Lion outperformed Tiger in 4 areas: cost of sales control, profitability, cash management, and asset allocation. In the financial ratio analysis, Lion showed better net profit margin, higher debt saving capital, and better asset and better asset turnover. After the above three parts of financial analysis, we believe Lions stock is a better investment choice in the following 5 ways. The reason of the Lion company's shares as the better investment. Number one, Lion had high growth margins, better EBIT, higher cash reserves, no account receivable. And number two, Lion outperformed Tiger in terms of net profit margin. And number three, Lion outperformed Tiger in terms of accountants and notice receivable turnover and inventory turnover. And number four, Lion has a higher quick ratio. And number five, Lion has a low P ratio. So now we can give the conclusion of the facial analysis of this assignment. Lion's overall income statement and balance sheet performed better than Tiger's. After conducting a comprehensive financial analysis of Tiger companies and Lion companies using tools like vertical analysis and financial ratios, Lion companies emerges as a more appealing investment. Despite both firms demonstrating solid financial health, Lion company outperforms Tiger in terms of net profit margin. In features of margin, receivables, and inventory, and total asset turnover, indicating stronger profitability and operational efficiency. While Tiger's high PE ratio suggests great market expectation, Lion's low PE ratio might slightly potential for price appreciation. Given its solid financial performance, however, it's essential to remember that investment decision should also factor in industry dynamics, market conditions, the company's growth strategies, and the investor risk tolerance. Therefore, taking all these aspects into account, Lion company seems a more promising investment choice. So, thank you watching.